Thursday, September 21st, 2023, Monaco 64, home of alternative economics and contrarian views. So we're going to look at the bond market, the Fed. There's a lot going on, of course, not just in the markets and as it pertains to monetary policy, but also to what's going on socially, politically, economically, geopolitically. I've been around for, well, it's going to be 59 years on October 3rd. And that's my birthday. And I haven't seen the world as crazy as it is. Yes, I grew up in Brazil in the 70s and early 80s. It was crazy over there, but that wasn't the whole world. It was just a third world country, I guess, an emerging market having its usual problems. But now the whole world is experiencing it, and I think that's a really bad sign in terms of, everything that's going on in the world. It's like the end of an era, and usually in the end of an era, there's a lot of crises, but there's also opportunity, of course. So today I just want to focus on the banking sector in the US, and it might sound weird, but I think what the Fed's trying to do is a lot of you out there are going to be hurt because of that, because not all of you have their accounts with JP Morgan or with the too big to fail banks, or are in a position to be prepared to take huge losses, and we think it's going to pick up again. And why do I say that? Well, because the bond markets are giving really bad signals, i.e. bond yields are continue to go higher. Even after the Fed announcement yesterday, the Feds did keep rates unchanged, which was pretty much what was expected. But for some reason, they became a bit more hawkish for next year, which is strange. That kind of confused people. And I don't know, maybe the Fed and Jay Powell actually don't really know what they're doing. I think someone noted yesterday, I saw on Twitter, that about a year and a half ago, even though CPI was running around 5%, the Fed funds were still at 1%, and they were predicting that by 2023, CPI or inflation would be back to 2%. They had no clue what was going on. They had forecast a year and a half ago, before they started raising rates, that rates would be back down. And here we are still seeing rates rise. And they're saying they might raise rates again. So yeah, what's going on? There's a lot of confusion, and we're going to look not just at the US bond market, but at the Japanese bond market, which, as I've said many times, is really important to the whole Western system because of the strategy of the Japanese yen carry trade. And if you don't know about the yen carry trade, I do have a playlist, which I'll put it up in the cards, but I'll explain it now very briefly. Basically, for the last 20 years, Japan, they were the country that started this policy of very low rates, zero rates. They didn't allow their economy to really, well, they didn't allow the forest, the old trees to burn down in the forest. They kept saving the zombie banks, the zombie companies, and they've been doing it for, well, how long is it now? It's 30 years. 3 lost decades. They haven't allowed things to go correct. But now it's all unraveling. And the way this has helped the West is that the Japanese, being huge savers, they've funneled, or they've put a lot of their savings into dollars and other Western assets that were yielding more. And that's called a carry trade because they were getting very little return for their savings in Japan. But now in Japan, rates are starting to go up because the Japanese yen is having a tough time. It's still dipping as we speak, even though Japanese JGB yield is up to the highest level almost in 10 years as I speak here. And many of you, of course, have always been concerned. There's always talk about, well, if bond yields start going up, isn't that negative for gold? Well, ever since rates started ticking up in Japan in 2019, 2020, from even negative in the 10-year to now almost 0.75%, look at what the price of gold in Japanese yen has done. It's gone through the roof, and it's going to continue to do so. And why is that? Well, because the bond market scenario or environment we're seeing now is not one that is a correction in a bull market in bonds. It's not one where we're going to see, again, low rates back down to zero. No, it's the end of the era of free money, in my opinion, of that central bank injection of easy money, and that's over. And that's hurting a lot of not central banks, well, central banks as well. Central banks, they have huge losses on their balance banking sector because the small regional, all the banks, they pretty much mirror the central bank's balance sheet. And now with bond prices going down, their balance sheets are starting to look really bad. Yes, we only get the results for the third quarter in the beginning of December from the FDIC, the quarterly banking report. So we're going to have to wait a while to see what's going on. But here we are towards the end of the third quarter, and we're seeing the 10-year yield and other bond yields continue to rise. We've just made a new high this year, above 440. I've always said that 433, 436 level is really important, and here we are breaking through it. What that means is bond prices, especially long-dated bond prices, they will come off a lot. Yes, the banks are going to be able to keep a lot of these on their held to maturity, which means they can keep valuing it at par. But depositors, as we saw it back in February, March, they will see that. And Yellen testified a few months ago because the FDIC did save depositors of these SVB and the other banks that failed. They saved some of the depositors that had over 250,000. But she testified to member of Congress from Oklahoma who asked, what if a small bank in Oklahoma goes? Well, it depends. It's something that we'll look into. So do you want to depend on Janet Yellen for the safety of your deposits? I'm not saying all of you, of course, have more than 250,000, but there are a lot of small businesses out there who won't be exempt. This doesn't just apply for individuals. So their hope is that, I think someone just tweeted out that Powell yesterday said, we will know when something breaks. So, yeah, he's waiting for something to break massively. Then he can maybe try to salvage something. Will it be too late? It might very well be, because they've been behind the curve for the last few years. They thought inflation was transitory. They thought the economy, was doing well. I think he said now that the soft landing is not really the scenario that he sees. So what does he see? Yeah, it's all up in the air. So why is gold doing better in this environment? Well, because this is not a Goldilocks environment. This is an environment where we're going to see a lot more bank failures. And if we don't, if we see the Fed inject liquidity or into these banks through their new bank term lending facility, or BTFP, well, the market will know that, and that's also inflationary. So it's very confusing what's going on. But apparently this is what Jamie Dimon, the guy who's probably looking to benefit from all this havoc, this is what he said, and I quote, "The United States government is going to have to sell net new bonds of $2 trillion next year and roll over another $5 trillion. And by next year, I think he means the next fiscal year. Could be 2024, but anyway, it's a big amount. Central banks and governments are selling more bonds than they have ever sold before." Yeah, that's the quantitative tightening. And then some natural buyers like China and Japan are going to be buying less, if not selling. Yeah, you bet. Japan is trying to keep its currency from dropping too quickly because they need to raise rates. They're still behind the curve. But anyway, this is how he finishes. "So I'm on the cautious side on all that stuff, including credit spreads." Jamie Dimon, CEO of JP Morgan. What does he mean, including credit spreads? Well, he means that he's not just cautious on government bonds, treasuries, but he's even more cautious on corporates, municipal, mortgage bonds. They're going to do even worse. And I highly recommend this book again. And I haven't finished it, but you will understand what's going on in terms of interest rates. We've gone from an age where money was abundant and plentiful, and now we're going to an age where money has to be backed by something real. The central banks, I think they're realizing they can't keep going with this forever. And that's why I see real things, real assets, real productivity, real commodities, gold and silver become more and more important in relative terms. We're going to see these trillions and trillions upon trillions that have been created out of thin air because of very low interest rates. We're going to see a lot of it flow into the hard asset sector. And I think the gold as a percentage of investable assets is less. It's around 0.5%. And I think it could go a lot higher in the US. And that's why I keep holding on to my $20 gold piece, my St. Gaudens. That's why I keep a hold of my silver coins. And yeah, that's why I'm going to continue to keep stacking. Is it a period where you're looking to make or get rich quick, make a fast buck? Well, that's up to you. I actually think it's a period where, there is a lot of opportunities out there, and I don't profess to know them. But in the monetary sphere, in the precious metal sphere, I think there is great opportunity because we're going to go from a world where fiat was supreme to where fiat isn't supreme, and the dollar is not just the dollar that's going to go down. All the fiat currencies are going to go down, and ultimately gold and silver are going to reveal the true value of things. They're going to become again the ultimate measure of value. And at what price will that be? I don't know. But it's not just going to be a revealer of true wealth versus fiat currency, but also against other assets, in my opinion. So let's quickly look at where the markets are then this morning. It's 8:24 a.m. London time. Yes, gold got up to 1947, I think, yesterday. Yes, we're back down to 1927.50. But the dollar also rallied since then. But as I said, this up and down of fiat currencies against each other is just a distraction, I would say. But anyway, the high overnight has been 1932 and the low has been 1924. Silver is virtually unchanged. We're at 23.23. Yesterday, I think we got up to 23.60. So the high overnight is 23.28 and the low has been 0.1. What about the stock market? How do I see the stock market? Well, yeah, I think the stock market is going to suffer as well. I can't tell you if it's going to crash or if it's just going to stay pretty steady. It's hard to say, but I would say that the higher rates go, and I don't mean the Fed funds, because the Fed funds, of course, were left unchanged. But if we continue to see the longer end, like especially the 10-year, continue to rise, it's going to put pressure on stocks. So right now, the Dow future is down 71. The NASDAQ is down 63 points. These are the futures, of course. And the S&P is down 14 at 43.88. The pound is down 0.2% at 123.18. Of course, the Bank of England is meeting today. We'll see what they do. I think there's hope that they won't lift rates today because we saw CPI drop yesterday, but we'll have to wait and see. The euro is down about 0.15 at 106.44. And the dollar is unchanged versus the yen at 148.28. But the dollar continues to rise against the yen. The dollar yuan is at 730.89. That's unchanged. Let's check the ruble, which we haven't done in a while. Ruble is pretty steady. The dollar is unchanged at 96.27. To the other currencies, Aussie dollar is down 0.5%, 64.13. The dollar is up 1/4 versus the Canadian dollar, just below 135. And the Kiwi dollar is down 1/4 at 59.13. So to the general commodities, we've got WTI crude down 1.3%, 88.35. So is the rally in crude oil finished? I don't think so. This is just a correction in the continuing bull market, I would say, in crude oil. Brent is down 1.2 at 91.50. Platinum is down $4, trading around 926. And high-grade copper is down 1.4%, trading at 372.80. We'll finish off with the bond market. So, as I said, we saw U.S. Treasury yields rise. Well, the short end rose quite a bit. I was on the phone with a friend I used to work with. He's a bond guy. And all of a sudden, he saw the 2-year pop up like from 504 to like 512, and that's a huge move. And he said, "What's going on?" I said, "Well, yeah, the Fed's just come out." And he said, "Oh yeah." So right now, the 2 years at 516. It's up another 4 basis points. That's because the Fed said yesterday that yeah, they were more hawkish towards 2024, and that they may still raise rates this year. So there you go. The 10 years, I said, we've broken through decisively, it looks here, through that 436, 437 level. We're at 442 overnight, up 7.5 basis points. So that doesn't bode well for things. What could change that? What could make yields go back down? Well, if we get very weak data going forward, like the non-farm data and other data, if we see that the economy is slowing down, but we'll have to wait for those. As I said as well, the Japanese 10-year yield is now fast approaching 0.75%. They were able to keep it around 2013, and 2013 was the period when they started this crazy Abenomics. That's when they announced it, when they went even more hell-bent into money printing and keeping the yen weak. So it seems to be all reversing now. What about the UK yields? They must be impacted this morning. Yes, the 10-year yield is up 10 basis points. It's trading back towards that 5%. We're still at 495 though. The 30-year is up 8 at 471. So wild times ahead. I see a lot of dangers, but a lot of opportunity as well. And one thing I would say, try to maybe block out all the noise out there. I know it's difficult to do it sometimes, even if you don't watch TV or the mainstream media, and it's very hard not to see what's going on. But anyway,